Today, we're going to break down one of the classic tools in any trader's toolkit, the on-balance volume indicator. Its entire purpose is to help us figure out if a stock's move has real power behind it, or if it's just noise.
It's the big question, isn't it? You see a stock price just take off, or maybe it starts to fall apart. Is this for real? Is it the start of a trend you can ride? Or is it a head fake, a trap set by what some traders call dumb money? How in the world do you tell the difference?
Well, that gets us to a really fundamental idea in trading. The price tells you what is happening, but it's the volume, the sheer number of shares being traded, that tells you how much conviction is behind that move. It really is the secret sauce that separates a weak, flimsy move from a powerful, sustainable one. So, to really understand any trend, we first have to get the relationship between these three things straight.
And look, this is not some newfangled idea. This is a cornerstone of technical analysis, a key part of Dow theory going way back. The principle is so simple. A real, genuine trend should have rising volume as the price moves along with it. This is basically the footprint of the smart money, the big institutions. Why? Well, think about it. They can't hide their huge orders. That massive buying or selling pressure has to show up in the volume data.
Okay, so if volume is the key to everything, how do we measure it effectively? Well, that brings us right to our main tool for today. Let's meet the on-balance volume indicator, or as we'll call it, the OBV.
The OBV was developed way back in the 1960s by a technical analyst named Joseph Granville. Now, Granville was a fascinating character. At times, his newsletters were so powerful they could literally move the entire market. And his whole philosophy was built on this one powerful, central idea. Volume moves before the price does.
So, what is the OBV exactly? It's actually elegantly simple. All it is a running total of a stock's trading volume. The indicator just keeps a cumulative score, adding the day's volume when the price closes higher and subtracting it when the price closes lower.
Let's just break that down because the logic is incredibly straightforward. On a green day, where the price closes up, all of that day's volume gets added to the running total. On a red day, where the price closes down, that day's volume gets subtracted. And what if the price doesn't change at all? Well, the OBV line just stays flat. That is literally it.
And here you can see the math in action. This table just shows that simple running total, adding volume on up days, subtracting on down days. But here's the key thing to remember. The absolute number itself doesn't matter at all. The only thing we care about is the direction the OBV line is heading. Is it going up, down, or sideways? Okay, so now that we know what OBV is, there are really two main signals we're looking for when we use it in our analysis.
And it all boils down to this. When the price and the OBV line are moving together in the same direction, that's confirmation. That tells you the trend is healthy. But when they start moving in opposite directions, that's divergence. And divergence is a huge warning sign that the trend might be running out of gas.
So let's look at the first type, a bullish divergence. This happens during a downtrend. The stock price hits a new lower low, which on the surface looks really bearish. But underneath it all, you look at the OBV line and it's refusing to follow. It's holding steady, or maybe even making a slightly higher low. This is such a powerful clue that the sellers are getting exhausted. The volume just isn't there to support more selling. So take a look at this chart for Starbucks. The price in that top panel, it clearly makes a lower low in July. Panic time, right? But now look at the OBV in the bottom panel. It holds its ground, actually forming a higher low. Volume was quietly signaling that that selling pressure was fading away. And sure enough, the OBV broke its own resistance line before the price did, and the stock just took off.
And the exact opposite happens with a bearish divergence. This is what you see in an uptrend, where the stock price pushes up to an exciting new high, and everything looks great. But the OBV indicator is telling a completely different story. It fails to make a new high, and that suggests that the buying pressure, the volume, just isn't strong enough to support this new price level. The enthusiasm is starting to fade.
This chart of Medtronic is a textbook example. In that divergence period marked by the blue lines, you can see the stock price creeping up to a new high. But look at the OBV line. It's clearly sloping downwards. The smart money was not participating in this final push. That lack of volume confirmation was a massive red flag. And just as Granville's theory predicted, the price soon followed volume and fell significantly. So how do we actually turn this theory into a repeatable trading strategy? Let's take a look.
So here's one way you could build a strategy for going long. First, you confirm you're in an uptrend where both the price and the OBV are rising. We could use a moving average to measure that. Then you wait for a pullback in price. But, and this is the absolute key, the OBV's moving average has to stay positive, showing that volume is still strong. Your signal to enter the trade comes when that price dip finally ends and its own moving average turns up again.
And here we see that exact strategy playing out on a chart of CVS. You can see at point 1, both price and OBV are in a clear uptrend. Then, at point 3, the price pulls back. You can even see the background turn red. But crucially, the OBV trend stays positive. The selling was weak. It was dumb money stuff. The entry comes when the price trend resumes, leading to a really strong move up.
Okay, before you start using this, we have to talk about the limitations. No indicator is a crystal ball, and it is absolutely crucial to know when the OBV can lead you astray.
Just look at the difference here. On the left, you've got that winning CVS trade that happened in a nice, clear trend where the strategy worked beautifully. But on the right, in a choppy, sideways market, the OBV just generates a ton of false signals because there's no real trend for the volume to confirm in the first place. So it is essential to remember these limitations. First, as we just saw, OBV is a trending indicator. It struggles in sideways markets. Second, a huge one-day volume spike, maybe from an earnings report, can throw the calculation way off for a while. And most importantly, OBV should never be used on its own. Think of it as a confirmation tool, best used with other forms of analysis.
And ultimately, it all comes right back to Joseph Granville's foundational idea. This is the entire philosophy boiled down. Volume precedes price. If you can remember that the flow of money often tips its hand before the price does, you'll have a much deeper understanding of the market.
So I'll leave you with this question. The next time you see a stock making a dramatic move, either up or down, I hope you'll pause and think beyond just the price. I hope you'll look under the hood and ask the most important question you can. Is there real conviction here? But where's the volume?